Imagine you're a homeowner with a mortgage. You make monthly payments to a lender. These payments are then pooled with thousands of other mortgages to form a mortgage-backed security, or MBS. Now, imagine you could invest in a basket of these MBS, just like you invest in a basket of stocks through an ETF. That's precisely what MBS ETFs allow you to do. They offer investors exposure to the housing market and the potential for steady income streams. MBS ETFs are like diversified portfolios of mortgages. They provide a convenient way to invest in the mortgage market without directly buying and managing individual mortgages. When homeowners make their mortgage payments, those payments flow through to the MBS ETF holders as dividends. This makes MBS ETFs attractive to investors seeking regular income. However, like all investments, MBS ETFs carry risks. The most significant risk is interest rate changes. When interest rates rise, the value of existing MBS tends to fall, and vice versa. This is because when rates are higher, new mortgages are issued at those higher rates, making older, lower-rate mortgages less attractive. The year 2020 will forever be etched in our memories as the year the world stood still. The COVID-19 pandemic sent shockwaves through every corner of the global economy, and the financial markets were no exception. Amidst the panic and uncertainty, MBS ETFs, once considered relatively safe havens, found themselves caught in the crosshairs of a perfect storm. As lockdowns rippled across the globe, businesses shuttered and millions found themselves jobless. The specter of widespread mortgage defaults loomed large, sending shivers down the spines of investors. Fear, as it often does in times of crisis, became contagious, leading to a mass exodus from risk assets, including MBS ETFs. The chart above paints a stark picture of the carnage that unfolded. The MBB ETF, a popular MBS ETF, witnessed a dizzying plunge in value, shedding nearly 20% in a matter of weeks. Other MBS ETFs like VMBS, JMBS, and SPMB suffered similar fates, as panic selling gripped the market. The once placid waters of the MBS market had transformed into a turbulent maelstrom. While the COVID-19 pandemic was the immediate trigger, the precipitous decline in MBS ETFs was exacerbated by a confluence of economic factors. Understanding these factors is crucial to grasping the magnitude of the crash and the subsequent challenges faced by the MBS market. First and foremost, the pandemic sparked fears of a surge in mortgage defaults. With businesses forced to close and unemployment skyrocketing, many homeowners faced the grim prospect of being unable to meet their mortgage obligations. This fear of mass defaults led investors to dump MBS, anticipating a wave of losses. Second, the Federal Reserve's decision to slash interest rates to near zero, while intended to cushion the economic blow, inadvertently added fuel to the MBS fire. Lower interest rates, while beneficial for borrowers, reduce the attractiveness of existing MBS, which offer lower yields compared to newly issued ones. This discrepancy in yields further dampened investor sentiment towards MBS. The initial shock of the 2020 crash gradually subsided, but the road to recovery for MBS ETFs proved to be long and winding. The economic landscape left in the wake of the pandemic presented a unique set of challenges for these investment vehicles. Navigating this terrain required a deep understanding of the evolving economic dynamics and the factors influencing investor sentiment. One of the most significant headwinds facing MBS ETFs in the post-2020 world was the Federal Reserve's gradual shift towards tighter monetary policy. As the economy showed signs of recovery, the Fed began to raise interest rates to combat rising inflation, a move that put downward pressure on MBS values. Furthermore, the housing market, while not experiencing a crash, cooled considerably from its pandemic-fueled frenzy. Rising mortgage rates combined with persistently high home prices made homeownership less affordable, leading to a slowdown in home sales and a decrease in mortgage originations. This slowdown further weighed on the performance of MBS ETFs. Section 5. A Glimmer of Hope. Green Shoots of Recovery. Despite the challenges, the year 2025 brought a renewed sense of optimism to the MBS market. Economic indicators, while not flashing green across the board, hinted at a potential turning point, offering a glimmer of hope for the long-awaited recovery of MBS ETFs. One of the most significant developments was the Federal Reserve's signaling of a potential pause in its interest rate hiking cycle. With inflation showing signs of cooling, albeit slowly, the Fed hinted at a less aggressive approach to monetary policy, a music to the ears of MBS investors. Adding to the positive sentiment, the housing market showed tentative signs of stabilizing. While mortgage rates remained elevated compared to their historic lows, they began to trend downwards, breathing some life back into the housing market. This stabilization, coupled with the Fed's dovish stance, set the stage for a potential rebound in MBS ETFs. Section 6. Interest rates. The pendulum swings back. The direction of interest rates has always been a key driver of MBS ETF performance, and 2025 appears to be no different. However, unlike the previous years of relentless rate hikes, this year brought a welcome change: the anticipation of rate cuts. As inflation gradually eased, the Federal Reserve found itself with more room to maneuver. The central bank's shift towards a more patient approach to monetary policy, coupled with growing concerns about an economic slowdown, fueled expectations of rate cuts in the near future. This anticipated shift in the interest rate trajectory has the potential to be a significant tailwind for MBS ETFs. Lower interest rates would make existing MBS more attractive, potentially leading to an increase in demand and consequently higher prices for these investment vehicles. Section 7. The housing market, a slow but steady revival. The housing market, a key determinant of MBS ETF performance, has been through a tumultuous period. After experiencing a pandemic-driven boom, it faced a sharp cooldown as affordability issues took center stage. However, recent data suggests a potential turnaround in the making. While mortgage rates remain above their historical lows, their recent downward trend has provided a much-needed boost to affordability. This, combined with a slight easing in home prices in certain markets, has led to a modest uptick in home buying activity. This nascent recovery in the housing market, though gradual, bodes well for MBS ETFs. As more homes are bought and sold, more mortgages are originated, leading to an increase in the supply of MBS. This increased supply, coupled with the potential for rising demand due to lower interest rates, could create favorable conditions for MBS ETF price appreciation. Section 8. Investor sentiment, a renewed appetite for MBS ETFs. Investor sentiment, often driven by a mix of rational analysis and emotional responses, plays a crucial role in shaping market trends. After years of shying away from MBS ETFs due to rising rates and economic uncertainty, investors are now exhibiting a cautious yet renewed appetite for these investment vehicles. Several factors contribute to this shift in sentiment. The anticipation of interest rate cuts, the stabilizing housing market, and the relative attractiveness of MBS yields in a potentially lower return environment are all contributing to a more favorable outlook for MBS ETFs. This renewed interest from investors is evident in the recent uptick in inflows into MBS ETFs. While it's too early to call it a full-fledged rotation back into these investments, the trend suggests that investors are starting to recognize the potential upside offered by MBS ETFs in the current market environment. Section 9. Conclusion. A comeback on the horizon. The journey of MBS ETFs from the depths of the 2020 crash to the cusp of a potential comeback is a testament to the cyclical nature of financial markets. The confluence of factors that led to their decline, the pandemic, fears of mass defaults, and rising interest rates, has gradually given way to a more optimistic outlook. While challenges remain, the potential for interest rate cuts, the stabilizing housing market, and renewed investor interest suggest that MBS ETFs are well positioned for a comeback. The road to full recovery may be gradual, but the signs are encouraging. As we look ahead, MBS ETFs offer investors a potentially compelling opportunity to participate in a recovering housing market and potentially benefit from stabilizing or even declining interest rates. As always, thorough research and careful consideration of individual investment goals and risk tolerance are paramount. However, for those seeking income and diversification, MBS ETFs deserve a closer look as we navigate the ever-evolving landscape of the financial markets.